They wipe out these gains pretty easily, don't they? Just like that, the sellers take away months, if not years, of profits because they want to get ahead of a potential recession. And then they swap into the safety stocks that thrive in a slowdown. Welcome to the world of recession preparation, where it doesn't matter what prices you get on the sales or the buys, as long as they get done, which explains today's terrific action. Dow tumbling 8 or 9 points, S&P plunging 2.69%, and the Nasdaq plummeting 4.0%. Not only was this the worst day for the Nasdaq in 2.5 years, the Magnificent Seven shed an astounding 5%, and we're getting rid of the name Magnificent Seven tonight. It doesn't make any sense at all, okay? None. Some of the money taken from these long-standing winners went into the healthcares and oils, especially the ones with higher yields. Buying healthcare stocks makes sense. They're slowdown plays. Oils don't make a lot of sense, even the ones with high dividends. 3% ain't going to protect you in this one, believe me. And there is justification for the buy, safety, sell discretionary stocks. Tonight, Delta stock was just absolutely obliterated when the company announced a hideous shortfall, citing weakness in both business and consumer. What a dog.
The market is experiencing intense volatility, with investors aggressively shifting their portfolios in anticipation of a potential economic slowdown. This was one of the worst market declines in recent years, particularly for the Nasdaq, which saw its steepest one-day drop in 2.5 years. Investors moved capital into defensive sectors like pharmaceuticals, insurance, and dividend-paying energy stocks. Delta Airlines dropped sharply after issuing weak guidance, citing lower business and leisure travel demand.
So what the heck is going on here? We don't want to be hysterical, though. We want to be historical, and we want to be together. First, the whole market has changed because the president has changed. Trump, 1, favored the stock market and hated to see the Dow Jones Industrial Average down. Trump, 2, favors rebuilding America at the hands of our greedy trading partners by slapping their exports with big tariffs.
The market landscape is shifting dramatically, and it's not just about tech stocks tumbling. It's about major geopolitical and economic shifts, especially concerning tariffs, trade policies, and AI dominance. The Biden administration's trade policies and potential second Trump presidency are shaking up investor sentiment. Trump focused on rebuilding America through tariffs, pressuring China and other trading partners, which could disrupt global supply chains. The U.S. government has tightened restrictions on Nvidia's ability to sell high-performance chips to China, impacting future growth.
Let's take a look now at chip stocks. Nvidia leading those names lower today, extending those losses fueled by tariff and AI spending fears. The chip giant has already shed $1 trillion in value since hitting a fresh record high earlier this year. And when it comes to the Nvidia story, obviously a huge run, right? Up 800% in 2 years, but several factors colliding at once that make the sell-off that we're seeing sort of make sense when it comes to tariff uncertainty, export controls from the Trump administration. Then you've got DeepSeek pointing to questions about whether or not the amount of money that these hyperscalers are spending on AI is actually necessary. Could that be a downswing for Nvidia's sales? And then you've got the overall question of economic growth moving forward. All of that creates a scary soup when it comes to the Nvidia story. What is standing out to you when it comes to what's driving the sell-off here and any potential for recovery?
Nvidia has shed $1 trillion in market value, and its massive 800% rally over the past 2 years is facing serious headwinds. Trump-era-style trade policies are back in focus, and potential export restrictions to China could hit Nvidia hard. If Nvidia can't sell its high-end AI chips like the H100 and H200 to China, it could lose billions in revenue. Reports like DeepSeek are questioning whether hyperscalers, Amazon, Microsoft, Google, and others, are overspending on AI. The global economy is flashing recessionary signals, and a slowdown could lead to less corporate AI investment.
You know, I'm much more focused on the DeepSeek issue than I am on the tariff issue. And the reason for that is, and we've seen this, the way in which the tariffs have started to be rolled out have been in fits and starts already, right? And there's been a lot of posturing and then a pullback with negotiation. And tariffs can be changed, you know, not quite on a policy whim, but pretty close. The emergence of DeepSeek waking up the market and saying, hey, guess what? Perhaps there's a way to get more of these big models, more of this groundbreaking AI work done more cheaply, I think has really forced analysts to go back to the drawing board and say, are our assumptions around cost efficiency correct? Now, on the flip side, and this is where I think CEO of Nvidia, Jensen Huang, is just such a fantastic communicator. He did come out, do you remember, on earnings day and say, no, look, this was actually proof that for every dollar the hyperscalers invest, the productivity is going to be greater, which makes it even more attractive. Yes, of course, from a return on investment a perspective, that makes a ton of sense. But we don't really know which way it's going to land quite yet. And I do think sometimes we talk about what's the catalyst for a market move. Sometimes it's just something that forces folks to go back to their assumptions and question, is what we thought was the case really the case anymore? And to me, DeepSeek was that moment.
While tariffs and export controls are making headlines, DeepSeek's emergence might be a bigger long-term concern for Nvidia investors. DeepSeek is signaling that AI models could be trained and run more efficiently. If AI training becomes cheaper and faster, hyperscalers, Amazon, Google, Microsoft, and others may spend less on Nvidia's GPUs. This has forced Wall Street to rethink Nvidia's AI dominance and long-term growth projections. Every dollar spent on Nvidia AI hardware will generate higher returns, making Nvidia chips even more attractive.
And I wonder how you're thinking about, okay, let's say AI is cheaper, right?
Yeah.
And that means that, you don't need the best GPUs in the world from Nvidia, and that weighs on their margins. What about the fact that Jensen Huang, you just think he's a good CEO, and maybe there's growth when it comes to robotics, maybe there's growth in self-driving cars and other forms of automation. Is that enough of a bull case for investors in Nvidia?
The physical AI, right? That's what he's come out and called it. I think right now people are saying maybe it is, but I don't know. And I'm re-underwriting, and I'm taking the new data, and I'm starting to look for new facts, right? I think it's only now that the market has said, okay, well, we better go check out that thing that Jensen Huang talked about, which is things like robotics. And you're starting to see more of that narrative come into play. But if you look at what's happened, TSMC, as you said, Madison, had pretty good news out today, up nearly 40% revenue for the 2 months so far this year, but the share price is down. Right, so I think if you look at ARM, the share price is down year to date. I just think that there's a real re-underwriting going on right now. And suddenly other parts of the economy are looking more attractive, like defense, for example, as Omar, our guest, just said, other parts of consumer staples. So I think we have to wait and see.
With AI potentially becoming cheaper, there's concern that Nvidia's GPU margins could be pressured. If AI becomes cheaper to train, companies may not need Nvidia's most powerful GPUs, cutting into their high-margin revenue. The market is reassessing Nvidia's long-term AI growth, as well as the value of semiconductor stocks overall. AI stocks are slipping. Even ARM Holdings and Taiwan Semiconductor Manufacturing Company, key AI supply chain players, are down despite strong revenue numbers. This suggests a broader shift in investor sentiment, not just Nvidia-specific worries.
Yeah, seeing a lot of momentum unwinding happening under the hood of the market, and it's really important to take a look at those semi stocks. You can see Marvell, too, really tough over the last 5 days, down over.
Well, I'm not joining the panic. The S&P 500 is down 8.6%. from its February 19th peak, so it wasn't that far back that it actually hit a record high. And if you look at the 11 sectors of the S&P 500, only one of them, that's consumer discretionary, is actually in correction territory, which is pretty impressive considering that the Magnificent Seven are down 16% from the February 19th stock market high. So I think the market's actually held up remarkably well in the face of the major correction in the Magnificent Seven. And so I'm not giving up on American exceptionalism. I think what's happening is a lot of the technological innovations that have driven the Magnificent Seven are now actually benefiting the productivity of the S&P 493.
The market has been hit by a correction in tech stocks, with the Magnificent Seven down 16% since the February 19th peak. But despite this, the S&P 500 is holding up well, only down 8.6%, suggesting the market isn't in full panic mode. DeepSeek's AI efficiency improvements have raised concerns about AI infrastructure spending. Investors are questioning whether companies really need to invest billions in Nvidia's high-end GPUs. Trump-era chip restrictions are still weighing on semiconductor stocks. Despite the tech drop, only one sector, consumer discretionary, is in correction territory. The rest of the S&P 500 is showing resilience, driven by stronger economic fundamentals.
If U.S. exceptionalism is on pause, how long is this pause, you think?
I don't think it's going to be very long. I think right now we had some very overvalued Magnificent Seven stocks. They were selling at a forward PE of 30 a few weeks ago, and now they're down to 26, maybe 25. So we've had a significant correction in the valuation multiple, but these are still great companies. A lot of them are cloud companies. There's still a tremendous demand for cloud, and that's only going to increase with artificial intelligence. So this idea that they're spending all this money on data centers, and it's not necessary. I think that flies in the face of the fact that they've got tremendous demand from customers to do more computing on the cloud and more storage on the cloud.
Despite the tech sell-off and rotation into defensive sectors, many believe that U.S. economic leadership and tech dominance are only taking a short breather, not experiencing a long-term decline. Magnificent Seven valuations have reset. A few weeks ago, these stocks were trading at 30 times forward earnings, but after the correction, they've dropped to 25 to 26 times. This makes them more reasonably valued. The demand for cloud computing and AI-powered services is still growing. Companies are continuing to invest in data centers despite concerns about AI infrastructure spending cuts.
The thing is, Ed, despite your optimism that, U.S. exceptionalism is possibly on pause, there's data out there suggesting that the U.S. economy is weakening. That can be seen from the latest data. And of course, when you take a look at U.S. policy uncertainty, that is at the highest level in 25 years. So surely that may have an impact on sentiment.
Well, there's a really high noise to signal ratio in the economic data, just the way there is in the political realm these days. But for example, we all are familiar with the Atlanta Fed's tracking model for GDP, and that now shows a decline of about 2.5%. And that was after showing an increase of about 2.5% only a few days ago, actually. A lot of that had to do with this bizarre surge in imports during January, and everybody thought that was companies front-running tariffs. Some of that was what was happening, but they were also front-running tariffs on gold bars. I mean, there was a huge imports of gold bars during January, and that's not something that's going to be sustainable, or I think that's going to be reversed in February and March. Also, we had the coldest January since 1988. And as a result of that, retail sales declined sharply, as did overall consumer spending. And I think that's going to be reversed in February and March, and we'll see consumer spending make a nice comeback. And the same thing goes for employment. Employment growth did slow in January and February, but I think it's going to make a big comeback in March and April.
U.S. policy uncertainty is at a 25-year high. GDP growth estimates have been volatile, dropping from plus 2.5% to minus 2.2%, according to the Atlanta Fed model. Retail sales and consumer spending slumped in January due to cold weather and tariff front-running. January was the coldest since 1988, reducing retail activity. Warmer months could boost spending. Employment weakened in January and February, but seasonal factors may lead to a strong recovery in March and April.
People, what are you doing right now?
Well, look, in my opinion, the jury's still out on whether these stimulus programs that the Chinese government has put together to boost consumption, and whether the German program to improve German industry, I think the jury really is out on whether these things are going to be successful. I mean, I think we know that given the American attitude towards defending Europe, that a lot of spending is going to go on defense, and I guess that can be stimulative, but it's not really going to make Europe suddenly an economic powerhouse. Europe really lacks a capital market that is as vibrant as the American capital market, that's constantly providing financing for new ventures, for new technologies. And China has a rapidly aging demographic profile, and I don't think they're going to be able to stimulate their consumers. So I think, yeah, the stock markets in Germany and China have had a nice run here, but I think they're going to kind of fizzle out once these realities come into better focus. And I think, meanwhile, the U.S. economy is going to turn out to be remarkably resilient in the face of what we're seeing as a lot of chaos and confusion coming out of Trump 2.0. But I think the economy handled the tightening of monetary policy in the U.S. remarkably well over the past 3 years, and I think that's going to continue to be the case. So I think there's tremendous value here in the Magnificent Seven and a lot of technology names, semiconductor names. I think those names are going to turn out to be good values. I think this is a buying opportunity and not a reason to panic out of U.S. stocks or to greatly change asset allocation away from the U.S. Towards either China India, or Germany or France.
So, is Citi wrong? Citi downgraded the U.S., upgraded China to overweight.
Nobody's wrong in this business. Everybody has an opinion. That's all there is to it. You know, I mean, at the end of the day, the market tells you whether you're right or wrong. So nobody knows right now who's right, who's wrong. I guess we can come back in 6 months or 12 months or whatever time period. But look, China's been a frustrating market for a long, long time.
Bear case for U.S. stocks include U.S. uncertainty, such as policy shifts, tariffs, and election risks. The Magnificent Seven correction is notable, with a 16% drop from February highs. Additionally, Citi has downgraded U.S. equities and upgraded China to overweight. Bull case for U.S. stocks includes the ongoing boom in tech and AI encompassing cloud computing, semiconductors, and robotics. The U.S. has shown resilience. Despite rate hikes, the economy has held up well. Moreover, Europe and China are struggling. China's consumer demand is weak and Europe lacks strong capital markets. China has stimulus uncertainty and Germany has an industrial push.
Well, Apple delayed its AI updates to the Siri digital assistant for the foreseeable future. Steve Kovac joins us right now with more on why this happened.
This is a big whiff right now. So that big AI update that we've been waiting for, that analysts have been waiting for, it's not coming until what Apple says later this year. That likely means 2026. And this is really hurting that bull case going into the iPhone 16 cycle last fall, that those sales are going to be driven by Apple Intelligence. Now, to date, there have only been some minor artificial intelligence features released on the iPhone. That means tools to help you with writing, those summary notifications you get on your home screen, and then, of course, back in December, the integration with ChatGPT and Siri. But this was going to be the big one, the one that we were all waiting for, that apps, you could control them with Siri, it would understand you better, it would know what's going on your screen, kind of dive into your personal data stored on your phone and answer questions. The dream of Siri, that big upgrade we've all been waiting for, it's just not going to happen. And in the meantime, it's been kind of a lackluster cycle for the iPhone 16. Sales were down slightly in Q1 year over year, and sales in China were even worse overall, not just the iPhone, but overall China sales. Those were down 11%. And CEO Tim Cook at the time was telling us part of that was because there was no Apple Intelligence for those phones where they were, where the sales were a little bit weaker. And we're not going to have more clarity on when this big update to Siri is going to happen, likely until WWDC. That's that big developers conference they hold every year down in Cupertino in June. In the meantime, you have all these AI competitors just stepping on the gas. OpenAI, Google, Anthropic. We know just about every week they're shipping these new AI advancements constantly. And this delay, by the way, seems to be pushing back some other new hardware products that Apple's been working on. Bloomberg reporting over the weekend that smart home device was supposed to be like an iPad you stick on your wall to control all your home smart home appliances. That needed this new Siri update, and now it's delayed as well. And by the way, that bull case for Apple, if you think this artificial intelligence thing is going to move more iPhones, that's going to be pushed out into the iPhone 17. In the lead up to the commercial, Andrew, you were mentioning Citi took it away from its catalyst list. It also, Citi analysts, reducing how many iPhones they think are just going to be sold this cycle because of this one change. It's really hurting this narrative. In the meantime, Apple Intelligence, not really impressive.
Apple's much-anticipated AI upgrade for Siri is now delayed until at least 2026, which could hurt iPhone 16 sales and push back Apple's AI momentum. Siri's big AI upgrade was expected this year, making it smarter, more contextual, and better at integrating with apps. The delay pushes key AI features to the iPhone 17, 2025 at the earliest. Meanwhile, Google, OpenAI, and Anthropic are pushing AI advancements weekly, leaving Apple behind. iPhone sales are weak. The first quarter saw China sales down 11%, partly due to no AI upgrade. Competitors are ahead. Google's Gemini, OpenAI's ChatGPT, and Amazon's Alexa are evolving rapidly.
You know, trying to figure out who the winners are going to be in AI.
Right.
Is it going to be the ChatGPTs? Is it going to be Mark Zuckerberg with the new plans he has to launch it as an app? Will it eventually be the hardware that takes over? I mean, it's one of those really key important times, and it's hard to see who's going to come out on top with all of
the
this.
way I look at it,
it's a combination of all of it.
It's a combination of all, but the way I look at it right now, it's the cloud providers. You have Microsoft. I mean, their business is growing or re-accelerating rather, that Azure growth rate because of AI.
I just mean me as a consumer.
Oh, it's you?
Yeah, like as a consumer.
It's ChatGPT. I mean, they're far and away the most used of all these chatbots we talk about, even Microsoft Copilot and the Anthropic, Claude, on and on and on. They just aren't used as much as ChatGPT is. And this ChatGPT integration with the iPhone, that's kind of an admission from Apple saying, we can't even figure this out. We need to stuff this into Siri for now. And honestly, I don't know if you guys have used it. The ChatGPT integration isn't as good. It's better just to open the ChatGPT app and use it that way.
Right now, it's unclear who will dominate AI, but a few major players are pulling ahead in different areas. In terms of cloud providers and AI infrastructure, Microsoft Azure's AI is driving re-accelerated cloud growth with Copilot and its partnership with OpenAI. Google Cloud is gaining traction with Gemini AI, but it's still behind Microsoft. Amazon AWS has a strong presence but needs a standout AI product. In terms of consumer AI, including chatbots and assistants, ChatGPT from OpenAI is the most used AI chatbot, despite competition from Claude by Anthropic and Google Gemini. Meta, with Zuckerberg's AI plans, is launching AI across Instagram, Facebook, and WhatsApp, leveraging a huge user base advantage.
Yeah, this is a big whiff for them.
But what's the fix? Because it seems to me that either they're going to have to build something themselves from scratch super quickly, or they're going to have to create a much deeper partnership either with ChatGPT or with Claude or something.
And not just deeper, more deeper in the way that we're seeing it right now. Because right now, ChatGPT is just with Siri. Right. We think they're going to do it in China with Alibaba. But what if, yes, their own LLMs? So Apple Intelligence isn't just ChatGPT. They wrote their own language models to work on the phone. It's clearly not good enough to handle what they want to do for this supercharged Siri. They can't lean on ChatGPT for that. So, I mean, there are talks that they might have to start over. And we might not see this until next year. In the meantime, everyone's just rapidly moving forward.
Okay, here's a question, because I use an iPhone.
Yeah.
How much better, if it is at all, is an Android as it relates to AI?
The Google Gemini stuff is it's pretty good.
We don't talk about Gemini the most.
Yeah, and those Pixel phones are really good. Now, people necessarily aren't going to go out there and buy them, but yeah, they're doing. Samsung, by the way, also doing stuff, and then in China, you have Huawei also putting these AI features.
So is it a threat to the ecosystem?
It's definitely a threat to the ecosystem.
Apple needs a real AI strategy, and right now, they're behind. They should build their own AI from scratch. They already built Apple Intelligence, but it's clearly not good enough to compete. There must be deeper AI partnerships. If Apple doesn't invest in its own large language model soon, it must form a deep AI partnership, maybe with OpenAI, Anthropic, or even Alibaba for China. Galaxy AI features are gaining traction through partnerships with Google and Baidu. Apple lost market share in China due to local AI-powered smartphones from companies like Huawei and Alibaba. If Siri and Apple AI remain weak, more users might switch to Android for better AI experiences. Apple's brand loyalty is strong, but they need AI leadership to keep their edge. Now, if you're tired of these so-called stock market experts blabbing about the same picks over and over again, I've got good news. I found an investing newsletter that completely blows the competition out of the water. They find highly asymmetric stocks with low risk and high reward, the kind you'll never hear about on CNBC or other major stock market news sites. I'm talking about companies like Ukrainian agri-producers during a war, or Bank Handlowy in Poland, a solid bank trading at insanely low valuations. These companies aren't flashy. Many of them produce boring products or provide services in oil and gas, banking, and agriculture. But here's the thing, they make money. And by investing in stocks like these, you can too. For a limited time, they're offering a 30-day trial for just $1. But as a thank you for watching this video to the end, I can do even better. Click the link in the description and tell me your best email address so I can send you their recent newsletter for free. It comes with 5 stock recommendations as well as high-quality market analysis, so make sure you check it out. You've literally got nothing to lose.